Welcome to Bull Academy. I'm David. Today, we will discuss Tesla's potential entry into the ride-hailing market to take on Uber and Lyft as it prepares to introduce its robotaxi service in the coming years. We will do this by examining an analysis by an analyst at Ark Invest. Ark is a global asset manager specializing in thematic investing and disruptive innovation. The firm is rooted in over 40 years of experience investing in technologies that aim to deliver outsized growth as industries transform. Ark Invest, led by Cathy Woods, focuses solely on disruptive innovation and offers investment solutions to investors seeking long-term growth in the public markets. Today, Ark has over $11 billion in assets under management, and the company is one of Tesla's greatest bulls. Recently, an analyst at Ark published an article suggesting that Tesla could soon defeat Uber and Lyft at their own ride-hailing game, even before it delivers on its much-anticipated robotaxi service. Let's take some time to understand the analysis from Ark's team. The analyst, Tasha Keeney, starts her report by laying out the basis to her analysis along with the 4 areas in which Tesla could focus on to deliver a superior service to riders and drivers.
Quote, Ark has been on the record postulating that when autonomous taxis commercialize, Uber and Lyft will not be able to collect the 20 to 30% take rates they enjoy today. Now, however, they could be facing a more immediate threat: a Tesla ride-hailing network. Elon Musk has said that before launching an autonomous driving network, Tesla could debut a ride-hailing service with drivers for good strategic reasons. Most important, a human-driven ride-hailing network would allow Tesla to collect real-world driving data to feed its autonomous driving artificial intelligence training system. In addition to artificial intelligence training data, we believe a human-driven network would give Tesla 4 more competitive advantages relative to other ride-hailing players: lower operating expenses, more efficient financing and insurance, higher trade-in or residual values, and premium prices.
To begin her deeper analysis, Tasha explains how Tesla can achieve lower operating expenses in its human-driven ride-hailing network.
According to Ark's research, the cost to drive a Model 3 is roughly 30% less than that of a Toyota Camry, as shown below. In other words, both Tesla and its ride-hailing drivers could benefit from operating costs lower than those at Uber and Lyft. Based on Ark's analysis, 20,000 ride-hailing service miles and 13,500 personal use miles per year, the cost to operate a Tesla Model 3 will be roughly 26 cents per mile, 30% lower than the 38 cents per mile to operate a Toyota Camry. Tesla's cost per mile advantage could play out in a number of ways: higher take-home pay for drivers, lower prices than Uber and Lyft, and/or higher platform fees for Tesla. A combination of all 3 could be possible.
Next, Tasha goes into the details of how Tesla could offer more efficient financing and insurance to drivers in its own network. Understandably, vertical integration appears to be the theme of this analysis.
While Ark assumed the same insurance costs for both vehicles in the analysis, Tesla probably will self-insure and offer lower rates to its drivers. With the ability to collect driving data continuously from its vehicles and to provide discounts for the use of autopilot, we believe Tesla will be able to offer rates lower than traditional insurance companies. While Uber does not break out insurance costs, in 2019, Uber's short-term insurance reserves totaled $941 million at the start of the year, or approximately 13% of cost of goods sold for the full year. Lyft's insurance cost, inclusive of scooters and bikes, was 19% of cost of goods sold in 2019. For personal car insurance, Tesla's rates are nearly 30% below average. With a vertically integrated network, Tesla should be able to offer attractive financing terms to prospective ride-hailing drivers, say $7,000 for down payments and the balance paid from a cut of driver earnings on the network. Coming off lease, used Model 3s could seed the network at launch. Moreover, Tesla should be able to finance its own vehicles, while Uber and Lyft pay fees to third-party partners. While traditional auto loans are risky, Tesla will be able to disable ride-hailing vehicles, potentially retrieving them autonomously if owners stop driving them on the network.
Tasha continues her analysis by discussing the ability of Tesla to offer higher trade-in or residual value to drivers for their cars.
If passed as prologue, the trade-in or residual value of Tesla vehicles should be much higher than that for traditional ride-hailing vehicles. Tesla's Model 3 has retained 94.5% of its value on average after 1 year, nearly 15 percentage points or 20% more than the 79.9% of other vehicles on average. Unlike most vehicles, Tesla's performance improves with time thanks to over-the-air software updates and autopilot. A Model 3 purchased in 2017, for example, can drive farther, faster, and more safely today than it did 3 years ago. As a result, Tesla's ride-hailing drivers should benefit from a vehicle that not only improves in performance but also retains value relative to its counterparts over time. Further, Tesla's full self-driving package could offer drivers some job protection against automation. If Tesla does convert ride-hailing vehicles over the air into fully driverless cars, their owners should continue to earn income over time without driving, even if human drivers become obsolete. Then, former Tesla drivers would have invested in the equivalent of autonomous taxi medallions at bargain basement pricing. Although traditional taxi medallions have come down from their million-dollar highs, they still are nearly 3 times the price of a Model 3 with a full self-driving package option.
To close out her analysis, Tasha dives into how Tesla could reasonably charge a premium to riders for the luxury its cars would offer to consumers in its network.
Moreover, Tesla could charge premium prices for its service, like an Uber Select or an Uber Plus, which are $1 to $4 per mile more expensive than Uber X, depending on the trip length and region. Of course, Uber Select drivers also are completing Uber X trips, so average take-home pay averages out closer to $1 more per mile. Premium price services already in the market suggest customer segmentation possibilities, with higher take rates for luxury cars.
According to Tasha, the bottom line is that Tesla's ride-hailing service could steal significant market share from Uber and Lyft. The Analyst concludes her article by saying the following.
Already trading at roughly half their IPO prices, both Uber and Lyft are unprofitable today, even more so after the coronavirus crisis. If it were to launch its ride-hailing service within the next year, as fears of crowded subways and buses linger, Tesla could capitalize on pent-up demand, perhaps hiring former or current Uber and Lyft drivers, particularly given their respective decisions, both before and during the pandemic, to limit new driver applications. With better take-home pay potential, not to mention biodefense mode, the Tesla ride-hailing network could offer a compelling value proposition to both drivers and customers as they emerge from the pandemic crisis.
We will continue to watch Tesla and Uber closely. Lincoln, the founder of Bull Academy, is invested in both of these companies. As for Lyft, we don't see too much room for the company in the future of autonomy as it compares to Uber and Tesla. If you're interested in learning more about Uber and its plans to achieve profitability, consider watching our recent video on the bull case for Uber. Thanks for watching this video. If you enjoyed it, like the video below, subscribe to the channel, and hit the notification bell so you know the next time we publish a new video. And if you want to help the channel grow and reach more investors, consider joining our private Patreon community for just $12 per month. As a patron, you will also have a chance to win $200 each month for being engaged. Finally, to learn more about investing and building your wealth, be sure to visit bullacademy.org to watch more explainer videos. I'm David with Bull Academy. Thank you again, and have a great day.
The views quoted here were those of Tasha Keeney of Ark Invest, a CFA and analyst. The link to the source article along with disclaimers from Ark Invest can be found in the description of this video. Statements made in this video are not an endorsement of any company or a recommendation to buy, sell, or hold any security.